Well, hello, fools. We're so excited to spend the next half hour or so with the Chief Financial Officer of IBM, Jim Kavanaugh, and Matt Frankel, our Hidden Gems investment analyst, helping out throughout. Jim, thank you so much for this time.
Great. Thank you, Tom. I appreciate you having us here and looking forward to an engaging discussion with both of you.
Let's hope we don't let you down. We're so excited about this. I will say for investors of the Motley Fool, we have 8 recommendations of IBM. They have those investments have done quite well for us. We take a very long-term perspective with our investment strategy, so we're always looking to hold our investments for at least 5 years. Obviously, there's so many transactions in the marketplace and so much excitement about trading and sports betting and all the other things that people get drawn into. But we're very convinced that the best returns come in the equity markets to those who find businesses that are making improvements, solving the problems of the world, generating cash flow from it. And so it is within that frame that we begin our conversations. I'll just start, Jim, with maybe the standard question you might expect that investors or some investors may still think of IBM as legacy services and hardware versus software, AI, and all of the R&D investments that IBM has been making. What would definitively change that perception, do you think? What milestones should investors be watching as proof that we have a real transformation afoot here, and it's a couple of years in at least?
Yeah, well, thank you, Tom. I appreciate it. I think that's a great place to start because we today at IBM, we firmly believe we're a fundamentally different company than what we were 5-7 years ago under Arvind's leadership now as he's taken over the reins of the IBM company. But we've embarked several years ago on a major strategic transformation that I would argue was all about reinventing IBM. It was everything, Tom, from portfolio optimization and a bunch of moves around that I'm sure we could talk about, to underlying fundamental operating and business model transformation, to arguably the most important piece of what Arvind has really embedded and instilled in IBM, a cultural transformation. We are a very different company. And it starts with our strategy, a very focused strategy around what we believe are the 3 most transformative technological shifts that we're seeing today: hybrid cloud, AI, and emerging right now and becoming reality very soon, quantum. And if you take a look at it, we have done a ton of work around building a software-led, platform-centric company to capitalize on those 3 strategic shifts with a very important integrated value proposition of infrastructure. So yes, we still have a infrastructure led by the most enduring platform mainframe, but we also have a software business that we could talk about and a consulting business that brings an integrated value proposition together that has a multiplier effect of every time we land a platform dollar. Now, to your point, what is it going to take? Well, let's just put this in perspective. You've been following us, and we really appreciate the recommendations from you and the team overall, your trust, your confidence, and the investment overall in our great company. But what we've done over the last handful of years, we've taken a company that was in structurally declining portfolio growth, incrementally dilutive margins, and a free cash flow engine that was stagnant at best to declining. And over the last 3+ years, we have built a durable, sustainable revenue growth model. We've improved our operating margins over the last 3.5 years by 1,000 basis points. And we have basically almost 2.5 times our free cash flow, $5+ billion of growth over the last 3 years. And by the way, the market has rewarded us on capitalizing on that. Put it in perspective, over the last 3-5 years, our TSR is about 2x the S&P 500, and it's well above the S&P Tech over the last 3 to 5 years. And IBM, Tom, as you know, you've studied us quite well. We just celebrated our 114-year anniversary. And over the last 3+ years, we've created more value for our shareholders than the prior 111 years combined. Hit all-time stock price, all-time market value, all-time enterprise value overall. So now you say, well, where can we take this company going forward, to your question? Well, we laid out at our investor day last year in February, about a year ago to almost a day here today. And we said that we were going to fundamentally build the next leg of our shareholder value creation model that is built on 3 pillars: accelerating this revenue growth even faster in this company, 5+%, led by double-digit growth in our software book of business. 2, continued operating margin leverage, about 100 basis points per year. We think we've got significant headroom still to go. And 3, a free cash flow engine that is going to grow faster than revenue, expanding free cash flow margins each year that creates investment flexibility. You bring all that together, and the way I kind of summarize it to investors, our investment thesis: higher revenue growth, higher operating margin company, strong free cash flow yield, high return on equity, and a very attractive return to shareholder program with our dividend policy. That's kind of how I would sum up the beginning of this discussion, Tom.
That was a really great answer. And so one of the things that you mentioned there, you really covered some of the big growth drivers over the next few years. You've discussed the expansion of margins. I think you said 1,000 basis points in operating margin expansion. So you're doing that while simultaneously investing in those growth opportunities you just mentioned, say AI, hybrid cloud, all the ones you just mentioned. How are you balancing the focus on efficiency with the need to invest and innovate? And where do you see the largest opportunities to boost efficiency even further while you continue to do that?
Sure. First of all, operating leverage has always been an essential element of IBM's business financial model investment thesis overall. You go back to when we spun off Kyndryl and how we laid out today's IBM. And if you take a look at it, how do we drive operating leverage within the IBM company? I will tell you, and I'll bring you in-house in our management system. We have 3 levers of driving operating leverage. Number 1, portfolio mix. We are a software-led, platform-centric company. We've taken our software book of business from, let's just say, pre-Red Hat days, 7 years ago, 6 years ago, was only about 20% of IBM's portfolio. To Tom's opening question, fundamentally different company. Today, we exited 2025, 45% of IBM's revenue. Why is that important? Portfolio mix, high marginal profit dollar, high marginal level of recurring revenue, carries a high multiple. So portfolio mix, the fastest growing engine we have is software. That continues to drive significant cash generation, financial flexibility. So that's lever 1. Lever 2, I would tell you, is around productivity. Arguably the most important job of a CFO is disciplined capital allocation. So every dollar we invest, whether that's in organic R&D, which about over the last 3 years, we've invested over $20 billion of organic R&D around new innovation and bringing capabilities out, around ecosystem partnerships that we've been investing in, around go-to-market, around our services capability. That productivity bucket, every dollar we invest, I'm looking for an ROI or a multiplier out of that. And we've been making significant progress over the last 3+ years, as I talked about up front, 1,000 basis points of operating leverage. The third area is around efficiency. Think of this as our G&A structure. How do we operate and run our company overall? And that is a competitiveness discussion. How do we drive the most productive company in the world? And when you take a look at it, Arvind, for everything he has done, yes, he's brought a growth mindset to this company around innovation, around opening up IBM the strategic partnerships around talent, around risk taking. He's also brought a fundamental productivity mindset to this company. Speed, velocity, efficiency, value. And that culminates in what I like to call, I love flywheels as a CFO. Productivity. How do we sell the value or the importance inside IBM? Productivity leads to financial flexibility to invest, which leads to growth acceleration if we execute and become relevant to clients. So productivity, investment flexibility, growth. If you take a look at it, Matt, 2+ years ago, exit in 23, we went to the market and we said we see about $2 billion worth of productivity headroom we think we can get out of this business. We just finished 2025. That number's $4.5 billion. And when you take a look at it, the importance of that is every dollar of productivity we drive at our capital structure, it creates $3.5 of financial flexibility for us to invest back in organically to high value, hybrid cloud, AI, quantum, next generation technology and mainframe, many other areas. And it also allows us to invest in building out inorganic strategic acquisitions to build capabilities. So I think that is a very effective way of how we drive productivity to enable a mindset to reinvest back in the business. Oh, by the way, I'll end. We just finished our guidance here in January. We took up that $4.5 billion in 26. We took it up another $1 billion because we see more headroom as we deploy and leverage technology inside IBM, as we embed AI across our workflows. We see a lot of headroom on how we can actually continue to reinvent a much more productive company that creates that investment flexibility.
This is going to be a bit of a walking tour or a pub crawl because we're going to go in a couple different directions and circle back to some points you've just made around productivity and about change management and the culture at IBM today and the changes that have emerged over the last couple of years. But I want to turn right now to what's happening with AI, Agentic AI, and IBM's business. I've bundled 3 questions together in one. In fact, I had these 3 questions, and moments ago, I just turned to GPT and said, let's put it into one question. Let's see how well it did with this. Jim, how does organizational disruption from Agentic AI compare with earlier technology shifts like cloud or mobile, where the tools evolved, but headcount and core roles largely stayed the same at companies? And now here's where we're getting the blended question. So how is this disruption different than cloud or mobile? And are clients finding that effective AI adoption requires rethinking their team structures and their roles rather than just layering in AI onto existing workflows? And if so, third part, what share of IBM's consulting engagements include AI-driven workforce transformation or change management? How does that all weave together, if you can, 3 questions into one?
Okay. Well, you'll have to help me because I'm actually, as a CFO, I'm not very good at multiple part questions, as you know from our earnings call. But I'll revert back to you and you can refresh my memory. But let's take your first one, right? And then we'll go from there. What is in the history of the information technology industry? What has technology always been? It is a way to drive productivity and a source of competitive advantage. I would argue for worlds, economies, industries, society at large. This next evolution of agentic AI is going to be, and I believe, the most powerful form of competitive advantage and productivity that we will ever see, or let me personalize, I'll ever see in my professional lifetime overall. But if you go back, Tom, and you look at the client-server technology shifts, the advent of the services industry, the middleware era, to the internet, to the globalization era, to most recently, 10 years ago plus, the cloud explosion. Technology has always brought competitive advantage. It's always brought more productivity. Read that GDP. It's why it's the second most highest contributor to GDP behind healthcare. And I think this is going to be the same thing. Now, I think your second question had something to do, I think, around labor or human capital, et cetera. I think around technology and GenAI, GenAI will influence every workflow, every job, every skill, in every industry, without a doubt. By the way, revert back to your first part A question. In all of those technological inflection shifts that have happened, we have gotten more GDP growth. We have gotten more labor and human capital growth. Is it in the same areas and disciplines? No, because the value equation has to change. New industries were created, new markets were created, new companies were created, new skills, new job disciplines were created, and that's the evolution, I think, naturally of what technology does. I think the same thing's going to happen with AI overall. AI will influence. Now you bring it back, and I think I remember your third part of your equation around consulting. By the way, I would argue today that is a huge differentiator in the IBM company, because we are the only integrated information technology company that brings an innovative tech stack across hardware, software, services, platforms, AI, hybrid cloud, quantum, with a consulting business at scale across 175 countries that drives platform adoption and scale overall. I will tell you in AI, let me bring it home to myself, because not only as CFO, I have the fiduciary responsibilities for the company. I also have and been entrusted by Arvind and the board, everything from the strategy to the portfolio to all of the operations of the company. So when you think about how we're deploying AI, to Matt's question about productivity, this is tough work. To reinvent a company, it requires you to fundamentally change and rethink how you run workflows in a company. How do you run HR? How do you run supply chain? How do you run procurement? How do you run finance? How do you run sales, development optimization? The consulting aspect of bringing industry domain knowledge and strategy, technology, business consultancy is essential, I think, for companies, because companies, to get the scale and value realization of AI, they have to fundamentally change the way workflow gets done. Yes, it starts with data, but it's all about workflow optimization, and it ultimately is going to change operating and business models. So consulting plays a very important role. Hopefully I kind of touched your three, if I vaguely remember them.
You nailed them. You nailed them, Matt.
All right, well, I'm going to do kind of what Tom did and combine two of my questions, and it's because the first one's short. So this is definitely just a financial question. In your Q4 earnings, you reported that your AI book grew by $3 billion to $12.5 billion, I think was the total. Yep. So just for investors watching who might not know exactly what that represents, can you kind of break down what that means and how investors should think about its growth? And the second part is, how does the acquisition of Confluent, how does that play into your AI strategy from a long-term perspective? And how will that strengthen that number even further?
Sure. I mean, we're extremely excited about the Confluent. If you hopefully can see over my shoulder, we have a little of the props around some of the acquisitions and capabilities, but I'll come to Confluent here in a minute. First, around the AI book. First of all, IBM deploys enterprise AI. We're an enterprise company that improves the economics around real work, boosting productivity, driving increased innovation, starting and driving competitive advantage, as I talked about technology, and it's also fueling growth. Our book of business, we exited 2025, inception to date, so call that almost 2 years, $12.5 billion book of business. By the way, in the quarter, it was north of $3 billion, to your point, so thank you. Underneath that, it's really made up of, again, platform model, because we participate in all facets of models, software, agents, assistance, orchestration. So software book is about, north of $2 billion. By the way, in 2025, up nearly 80% overall. The remaining, call that north of $10.5 billion, is our consulting book of business. That's our strategy and technology advisory work around AI. That's our data transformation services to get companies ready to scale and deploy AI. And that's our intelligent operations, where we do application modernization, hybrid cloud architecture, et cetera. So that gives you a little bit of the background. We're extremely excited about where we think AI is going. You look at studies that have been produced, whether it's BCG, McKinsey, you name it. They're calling trillions, like 4 trillions of value creation over time around AI when it's at peak. And oh, by the way, interesting thing on that, just a little sidebar, only about a quarter of that is productivity. 3/4 of that is actual new sources of growth, new industries, new companies, new markets. And having an innovative tech stack and a consulting business at scale plays to our advantage. Now get to Confluent. Confluent, we're extremely excited. Open source company, we're very big in open source, starting with the initial Linux foundation that we started, but Red Hat acquisition, HashiCorp, Confluent plays extremely nicely to our strategy overall. Confluent, leading open source company around data streaming, events, real-time, foundational for GenAI overall. It is going to become the glue. If you think about GenAI, yes, you've got models. Yes, you've got applications. And by the way, we've been public. We think there's going to be an explosion in applications that are going to occur. On top of those applications, Matt, as you know quite well, there's going to be multiples of agents that call on those applications. What does Confluent do? It's going to be the smart data platform that is going to be foundational for us to have companies scale AI, because it brings the integration of applications, of data, of security, of governance, of intelligence together. Think models, applications, agents, and the connectors of all that is going to be the underlying data connector around Confluent. So we couldn't be more excited. By the way, it fits our M&A strategy. What do we look at in M&A? We look for category leading technologies in structurally growing markets where we can add unique value inside IBM around integration and around delivering synergies on top of our platforms. This fits extremely well with that overall. Expands our TAM, very important area. So we couldn't be more excited.
Well, I was going to ask you about your M&A playbook, because IBM's been an acquisitive company, and so many companies fail or at least miss their targets, their acquisition targets. And IBM's acquisition playbook has been playing out quite well. Since you've answered that question, I'm going to take us to a place that you can opt out of. It's like a game show here, and you can say, I'd prefer not to play that game if that's okay. And we would welcome that answer. And in fact, we're almost, I don't know if your device allows you to see these numbers clearly.
Yeah, I could see some numbers. They're small, but I could see it.
Okay. Well, this is IBM's fourth quarter performance numbers. Since we have the CFO, it gives us an opportunity to ask you. Now, if it's too difficult to peer in and see the numbers, we'll skip this segment. But if it's not, it gives us an opportunity to hear a little bit about how you think or what you're looking at when you see, for example, here, the December 31, 2025, fourth quarter, very top of the income statement. Is there any number or anything you'd like us to make sure we pay attention to as investors? I'm just going to scroll through the financials so we can move pretty quickly. You can just give some high-level comments if you'd like to, or pick a single number out.
No problem. First of all, highest revenue growth history of IBM in the fourth quarter overall. Printed, at constant currency, printed north of 6% overall. We've taken a company, like I said in the first answer, I think originally, Tom, that you asked, company that was structurally declining over the last 3+ years, converted that company to a durable, sustainable mid-single. We just exited one of the most successful years and quarters that we've had on record. Point number one. Point number two, we are a software-led platform company. Our software book of business grew double digits in the fourth quarter, I think 14% at actual rates, if I remember, a little over 11% at constant currency, give or take. Tremendous quarter, by the way, on a double-digit fourth quarter last year. Software now 45% of our book of business. 3 of our 4 categories in software, hybrid cloud led by Red Hat, automation, and our data portfolio, 3 of those categories all grew double digit. It's pervasive growth across the board, and I think resonating of us being a leader in where we think in the most transformative technological shifts are happening, hybrid cloud and AI. Top line growth. Second, boy, the most enduring platform that this industry has ever seen. Double-digit growth in infrastructure led by the most successful, unparalleled start to our next generation of Z17 mainframe. We're 3 quarters in. It's the most successful program overall, and it is the enduring platform where we have incumbency, we have moat, we have on-prem trust that we're able to build a synergistic multiplier to capitalize on top of that. So infrastructure, phenomenal year, double-digit growth. And consulting, we return back to growth in the second half, inflected. But more importantly, as you scroll down, what else is important? We already talked about the $12.5 billion book of business on AI and how we're becoming an early leader. We are driving the discipline and execution of a very highly operating leverage company overall. We finished the year at about 19 points of operating pre-tax margin. Gross margins, the highest in the history of the IBM company in 114 years. And our operating margins are up, I think the highest, I want to say, Tom, don't hold me, more than a decade. And you bring that down to free cash flow. We always talk about our 2 most important indices, revenue and free cash flow. Our free cash flow, $14.7 billion, up $2 billion year to year. Highest free cash flow margin in the history of the company. And when you look at the last 3 years, we've generated, I think, roughly $5.5 billion of free cash flow growth over the last 3 years, growing compoundedly high teens. So I think when you put all that together, pretty solid year for the IBM company. And that goes back to how I started, where the market is rewarding us by achieving that level of total shareholder return and multiple and highest stock price overall.
Just quickly on the balance sheet, let's just say an investor early in their career comes along. And of course, every company should want to attract every investor, no matter what stage they're at, and learning about how businesses work, how to value them, what to care about, what to not overrate. So if somebody just came in and said, well, the company has about $13.5 billion in cash on the balance sheet, but when I scroll down and look at how much long-term debt they have $54 billion. So they have $13 billion in ballpark cash, $54 billion ballpark long-term debt. This worries me. Tell me how you manage debt, how you accumulated that debt, obviously in part through acquisitions, and whether it's something investors should pay close attention to or not make a primary factor.
Absolutely. Great question. And thank you for the question overall. I get this a lot from investors. First of all, we have a solid investment grade balance sheet and liquidity position overall, with a capital structure that we use strategically to ensure that we create the financial flexibility through a disciplined capital allocation process to create long-term sustainable competitive advantage and value. That's what a CFO does. Now, why do I say that? First of all, solid investment grade. We're what, A minus from a S&P perspective overall. We're operating at a leverage ratio, which I think is the most important component. You gave some of the elements of that, of cash on the balance sheet and long-term debt, but our leverage ratios are hovering right around 2 overall, which I think are very solid for a high growth, highly acquisitive, high innovation-based investment company overall. I compare that to many other companies in our peer group, and we sit extremely well. Now, the question is, why do we feel comfortable? One, I think you had 13 point some billion. That's just cash, but cash and marketable securities. We have $14.5 billion of cash on the balance sheet. Tom, I will tell you, the way we have fundamentally repositioned this company, that is well in excess of the minimum operating level required to run this company. We can run this company on $3 to $5 billion of cash on the balance sheet. We have almost $15 billion of cash on the balance sheet. Second, we have a free cash flow engine that is on a vector. We just finished at $15 billion, $14.7 billion of free cash flow. That's on a vector of growing high teens. That creates that financial engine and flexibility of every dollar of free cash flow gets us $3.50 worth of financial flexibility at our appropriate capital structure. So part of this is, do we have the right capital structure with the right discipline to protect and preserve the balance sheet and liquidity? Absolutely. The real question then becomes with leaders, and especially as a CFO, is how are you effectively capitalizing on that financial flexibility? I always love to use, and I tell Arvin and our board always, I take very seriously about how you use debt strategically. On one aspect, to your point, you might look at $54 billion. I look at debt, how can I use it strategically to competitively position this company for long-term strategic value? That's why we were able to acquire companies. And by the way, we levered up Red Hat, HashiCorp, Apptio, Software AG assets, DataStax, and soon to be now Confluent, very strategically. But if you look at it, I think we've earned the credibility of being disciplined capital allocators with the return profile of what you've seen with our revenue acceleration over the years, with our operating profit acceleration, and with our free cash flow acceleration. And we feel pretty comfortable with that.
Just a quick follow-up. Let's just take these 4 factors, and if you have a formula for them or how you evaluate them from one quarter to the next, 1 year to the next, and that would just be share buybacks, dividends, acquisitions, and R&D. So taking those 4 different games you can play, how do you think about each dollar that comes in of cash flow and where to deploy it?
Yep. Well, discipline and capital allocation always starts with investing back in our business. That is both an organic and an inorganic, to the extent we remain disciplined around our set of M&A criteria. Strategic fit to our hybrid cloud and AI strategy. Synergistic value, because every dollar we invest inorganically, we got to get a multiple synergy. It's got to pull software, it's got to pull consulting, it's got to pull our infrastructure platform, and it's got to have an attractive financial profile. So our capital allocation strategy always starts with the biggest value creator, which is utilizing cash in the most productive and effective way to create long-term sustainable competitive advantage. From there, then, as a CFO and public company, you've got to look at any excess cash above your leverage ratios on how you would have an attractive return to shareholder program. Given our investor mix, and by the way, we've been doing a very good job of changing that over time, but we have a very sticky, a very loyal retail base. They love the dividend, and we've been very transparent. We remain committed to a secure, modestly growing dividend over time. I think right now we've given a dividend for 100 plus years, and we've raised our dividend. We're an aristocrat. Right around 30 years in a row. and we feel very confident. We've been able to grow into a pretty attractive, still attractive dividend yield at a very appropriate now payout ratio, much better than where we were 5-6 years ago. And then from there, given the free cash flow generation engine, Tom, that we've been driving here and the vector of growth, our return to shareholder program, we're approaching about 40% from a payout ratio. It gives us a lot of strategic optionality on how to distribute value back to our shareholders. If we see something that is very attractive inorganically, we're going to continue our organic engine. You can bet on that. That's priority number one. R&D, our research investment, our quantum investment, and the next leg of emerging technology. But if we see something very attractive that fits our M&A criteria, that will be highly prioritized. Otherwise, we'll look at strategically diversifying how we give out return of value to shareholders. And we're about at that payout ratio that allows us to have a lot of flexibility. So I call that a high quality problem.
All right, I wanted to ask a follow-up on capital allocation, and I'm glad you brought up quantum because we definitely want to get to that. So you mentioned quantum, you mentioned your R&D costs. When I'm looking at other, the big tech companies' earnings, the big story is spending. I think Amazon announced they're going to be spending $200 billion on infrastructure this year. Alphabet, it was about $170 billion. Between all the big tech companies, it's over $500 billion that they're going to spend this year. So quantum computing, it's going to be a lot of upfront investment before you get any return on that. We all know that. Same with a lot of what you're doing in AI. So how do you see IBM's capital needs kind of evolving over the next, say, 5 years? Should we expect a big ramp up like we've seen in other tech companies? Or I know it's not a total apples to apples comparison, but how should investors think of that?
Yeah, no, it's a great question. I get this question all the time. First of all, we've been investing in quantum for almost a decade. So it's not like we're just ramping up and starting that investment. That's why we feel very, very excited about the opportunity. And it sounds like you want to go to quantum next. But to your capital allocation and capex type investment models. First of all, IBM has a fundamentally different model. We are not a hyperscaler. We are not competing there. It's a co-opetition world, and we have significant strategic partnership relationships with each of the hyperscalers and the foundation model providers overall. And so we've got with Meta, we've got with Google and Gemini, with Microsoft and Copilot, you name it, right? We are not going to be investing significant amount of capex to leverage building foundational models overall. Our AI strategy is built on open architecture, driving rapid innovation through leveraging a developer community. It's a hybrid strategy overall, which, by the way, IBM is the only company that can build, manage, and deploy software for hybrid cloud and AI. It's a multi-model strategy where we leverage strategic partnerships in an asset-light model. They run the chips and the models. We run very targeted fit-for-purpose models, our Granite models overall, that are enterprise-focused, by the way, 90% more cost-efficient. But we leverage other people's balance sheets around their capex investments, around foundation models, LLMs, and we do inferencing on our side. And then we participate then in where we can have distinctive value. Our software data layer, our automation layer, our orchestration layer, the agents and assistants that we build. And let's not then forget, AI is on top of our Z17 embedded in the chip of our infrastructure. And it's also a huge component, as we talked earlier, around consulting. So it is more of a synergistic play of leveraging others' capex investments and where we can go capitalize on where we could create value within our portfolio overall. So I wouldn't expect a significant ramp up in capex. We invest about, give or take, $2 billion a year in capex. Yeah, maybe that goes up faster than revenue growth, but it's not going to be the tens or hundreds of billions of dollars of capex. That's not our model, and that's not where we feel we can extract value.
Okay, thank you for clarifying that for our investors. I wanted to just kind of briefly follow up on quantum because I know we only have a few minutes left with you. So IBM, like you mentioned, you've been investing in quantum for about 10 years. You're clearly leading a path toward quantum advantage, which is where quantum computers are superior to traditional models. So where are we on that roadmap, and where do you see? Because right now it's not reflected in any of those numbers that Tom put up on the screen. Where do you see in 2030 and 2035? Where do you see that? How big of a part of IBM do you see quantum becoming?
Extremely excited about quantum. I could spend the next hour, but I know we only have a couple minutes overall. First of all, they are embedded in some of those numbers Tom talked about. They're ramping nicely. When they get to a sizable level, let's just call it maybe $1 billion of annual revenue, then we'll start talking. By the way, we think that is in the near future overall, as we've been very transparent. But why are we so excited? First of all, from a CFO, what is the TAM? What is the market opportunity around this? You go look at studies from BCG, McKinsey, you name it. At scale, they think that quantum is going to create $850 billion to $1 trillion of value overall. Now, very quickly, I will tell you, IT providers are not going to capture 100% of that. But can we capture 20%, 30% of that value creation opportunity? This is a very big TAM market opportunity. Second, when you look at IBM, we've been investing for about a decade right now. We've got a strategy that we're building a platform model. What does that mean? Yes, we hear a lot about the hardware architecture of the quantum systems. And I'll talk about that in 1 second. But we're also building the infrastructure software layer that runs on top of the quantum systems. We call that Qiskit. And also very important for any platform model is you have to build out the network, the industry, the government, the SI firms, you name it. We are building out, and we've been investing over the decade to go do that. Now, let me give you some stats and numbers why we're excited. Number one, on the quantum infrastructure, the quantum systems, we have over 85 quantum systems in production today across almost every industry with use cases around many of major Fortune 50 companies overall. By the way, those 85 systems in production, they're more than the entire industry combined. We have such a leadership advantage. By the way, we just released in fourth quarter, you probably saw this in December, our 120 qubit system, Nighthawk, which is industry leading overall. So that's point number one. Point number two, Qiskit, that software layer. View that very analogous to 15, 20 years ago, what NVIDIA did with CUDA around the GPU layer. Our Qiskit now is the most written upon software platform for quantum by a factor of 4 to 5x. So we are embedding that into the ecosystems, academia world, you name it. And three, our network is north of 300 and growing strong. Industry, I call it a triangle. Industry, government, academia, all very important part around this. By the way, to your earlier point, and when I said it's embedded in some of the Tom's numbers, inception to date, we've got over $1 billion book of business on quantum today. That is a book. Think of it as a backlog, right? Like an RPO that will play out over time. And to your point, when does it scale? We've been very transparent. By the way, I think we were the first to market 3 years ago, where we laid out our technology development roadmap on quantum. Tells you how much confidence we have in this. We said by 2026, we will demonstrate quantum advantage. I think we're very, very, very close, albeit February 10th, of achieving that. It'll come out soon. Second, more importantly, the industry. It's not just an IBM statement. Second, we said, and this is where the scale comes, that by 2028, we will demonstrate error correction. Once we get to error correction, that is going to be the inflection shift in where revenue starts scaling at exponential levels. And we've got our Starling system coming out early 2029, given the confidence that we think we're going to be able to demonstrate. And I think from there, you're going to see substantial inflection. And we've said for a few years now, we think by the end of this decade, call that 29, 30, you're going to see scaled quantum contribution to the IBM company overall.
Final question is like the ski jump in the Olympics. It's not going to be a long runway to the question, but we're going to give you the opportunity to stick it quickly because we know we need to respect your time. So be as succinct as you'd like to be. I'd just like to hear from you. You are have a 30-year history at IBM. Arvind has a 35-year history. You came in as, I believe, stepped in as CFO in 2018, Arvind to CEO in 2020. We've heard about it through your points in this conversation, so I could probably answer this, but anything special you'd like to give us about what the Arvind Krishna years mean as distinct from what came before at IBM? And maybe if you wanted to go in this direction also, I'd love to hear transformation culture, how you're fair to every employee in this time of great change while relentlessly pursuing, the prosperity and success you want for all the stakeholders of the company with these new technologies.
Yeah, well, Arvind and I go back 20 plus years. We became very close when I was the controller of the company back in 2007. He was running parts of our software portfolio overall. We actually built a relationship on the business that ultimately led to a friendship outside, but it was a business relationship on what I would call one day a mentoring relationship. Him, deep technologist, me, deep business model, operating model, financial model, etc. And we learned from each other. Another day it was a reverse mentoring. So we became very, very tight, and our paths have crossed around different portfolio moves over time, Red Hat being the biggest piece. But what do I think of what he's done around this company? Number one, I think it will go down in history. He has probably engineered one of the most strategic reinventions of an iconic information technology company that's ever existed. And I say that proudly at the end of the day. There's a reason why we're here, 114, going to celebrate 115 years. What has he done? I think if you take a look back at it, I said to someone earlier this morning, I think there's three things that are important, which, by the way, go back to when Arvind and I were talking when he was interviewing with the succession plan to become the next CEO. Because I asked him, I said, what do you want to be known for? Where do you want to take IBM? Because I had just become CFO. And by the way, a lot of their behind the scenes things have happened leading up to both of our positions. But number one, he said, IBM historically has always delivered differentiated value over 114 years when we had high value innovation platform models that we could create distinctive advantage. Arguably, we haven't had one since the middleware era in the early 2000s. Allah, his vision, hybrid cloud AI, Red Hat acquisition, and what we've done with the portfolio. So he wanted to convert IBM into a platform-centric business, opening up IBM, which I think is one of the most underappreciated things he's done in the company, creating strategic partnerships, moving away from a historical proprietary IBM to one that is co-opetition and strategically complementary to other areas. Point number one. Number two, he had to change the mindset in this company that we've got to drive durable, sustainable growth, a growth mindset overall. And three, I think culturally, what has IBM always been known for? Responsible, ethical technology that makes a difference in the world, in industry, society at large, technology for good. I think in a very short period of time, when you check one, check two, check three, he's well on his path. And I think that goes back to how I answered your first question. That market valuation and how the market is looking at us, while that is great, that's in the rearview mirror, all-time stock price, all-time enterprise value, created more value in the last 3 years than the previous 111. What makes us most excited is the engagement and momentum of every IBMer with the step in their walk right now. And I think that's a pride statement and that's a relevancy statement with clients. So that's kind of how I would wrap it up.
Jim Kavanaugh, the CFO of IBM, thank you so much for this time. We're very happy investors thus far and looking forward to the next 5+ years, both learning from you as a business, enjoying the experience of getting to meet you in this situation, and making money for putting our money at work. And that's the mission of the Motley Fool, to create a world that is smarter, happier, and richer. And you've given us that to us in this time. So thanks very much, Jim.
Appreciate it. Thank you again. I appreciate your trust and confidence and investment. We'll keep making it work for you.